Digital credit is a killer application of digital capital. Bitcoin represents ideal capital. It represents engineered capital. It represents digital capital. In the middle of the crypto or the bear market here, in the crypto winter, Bitcoin peaked in October 6th. It was 125,000 a coin. It's 38% down. STRC is 0%. It's exactly held par. And so what you can see is that the credit instrument is something you can manage to hold principal value. And you need an issuer to do that. That's where the company comes in. In February, we got punched in the face. It was a really difficult month, massive Bitcoin drawdown, and it fell to 80 million in demand. In March, it jumped to $1.5 billion. It became an $18 billion a year product. Imagine going 0 to $18 billion a year in the first year. And then in April, it went to $3.5 billion. Multiply $3.5 billion by 12. All of a sudden, 0 to $38 billion a year in a run rate. It's not a year old. So clearly, we're in hyper growth right now. May will be interesting. June will be interesting. We expect that digital credit will drive the size of the Bitcoin network. And what's the end game? The end game isn't that complicated. It's give a bank account, an 8 to 10% a year yielding high yield digital bank account to 1 billion people, drive Bitcoin to $10 million a coin, and make Bitcoin a $200 trillion network until it grows higher.
Michael Saylor just said Bitcoin is going to $10 million a coin. Now, Saylor's been buying Bitcoin for years. Everyone knows that part. But what he's doing now goes further than just holding it on a balance sheet. He's built a financial instrument, Stretch, that sits on top of Bitcoin, borrows its performance, strips out the volatility, and pays regular people 11% a year in yield. He calls it digital credit. It grew from 0 to $8.5 billion in 8 months. It's now more liquid than any preferred stock Wells Fargo, JP Morgan, or Bank of America has ever issued. And it's not even a year old. But there's something that should make you uncomfortable. The entire thesis depends on Bitcoin continuing to climb. Saylor is selling people a stable 11% a year tax-deferred instrument. That instrument is backed by the same volatile asset that just dropped 38% from its peak. The question isn't whether this is impressive. It clearly is. The question is, what breaks first? Now let's watch him lay this out.
Digital credit, in a similar way, it's engineered credit. It's ideal credit. It's digital credit. How do we build it? What is credit? What is capital? Well, the world's built on capital. The world runs on credit. Capital is for someone that wants to make a long-term investment without cash flows. And they're going to bear all the currency risk, all the duration risk, all the volatility. They're going to bear all the uncertainty for a long period of time because they have a low time preference. And there are a set of people, set of investors that want that capital investment. But credit is for people that have a much shorter time preference. They don't want the risk. They don't want the wait. They want steady cash flows. They don't want the volatility. They don't want the anxiety. They have immediate bills to pay, and they want that cash flow now. And so our company strategy converts capital into credit. We take the BTC commodity and we convert it into a currency, like the US dollar or the euro. We stretch its USD. We take the risk that's 1 for 1, and then we over-collateralize to strip it away. If you collateralize something 5 to 1, that means that the capital asset can fall 80% and you're still fully collateralized. So the capital investor has lost 80% of their collateral. The credit investor is still protected. So you're stripping risk. When you do that, you damp volatility. The volatility of Bitcoin's been 40. We strip that volatility away when we strip the risk away by targeting a standard value. And from that, you extract a yield, a cash flow, And you do that while compressing duration. Instead of waiting a decade in order to get a capital gain, you get a yield within a month. The world's built on capital, the world runs on credit. We designed a lot of credit instruments, but after many, many tries, we finally discovered STRC. And STRC is built to provide the benefits of equity investors, like double-digit returns and tax efficiency, with the benefits that credit investors get, like low volatility and capital preservation. So if you can combine all of those together, you have the best of the credit world and the best of the equity world in a single instrument. A lot of people were surprised when we used a preferred stock to do this, but it turns out that digital credit is just the re-emergence of preferred capital after 100 years. If you go back to the 19th century and think about the last major capital development effort, which was railroads, most railroads and a lot of the early industries during the Industrial Revolution, they were financed by preferred stocks. It used to be 20 to 40% of the capital structure of corporations. In the 20th century, preferred stocks fell out of favor. It's almost like they were forgotten. And now in the 21st century, we've reintroduced the idea of preferred credit or preferred stocks back into the capital markets. Now, how do you create it? People always wonder, how do you create an 11% yielding credit instrument? Well, you start with the performance of asset classes. And if you look at the performance of Bitcoin over the last 5 years, it's up 38% a year, which is much better than gold or the S&P. Real estate's up 6% a year. Money markets are up 3% a year. You can't create a credit instrument that pays a dividend higher than the capital return of the capital that the credit's being invested in. So as you can see, the theoretical highest yield you could ever pay on gold-backed credit would be 16%. The theoretical highest yield you can pay on real estate credit is 6%. On the other hand, with Bitcoin, the theoretical yield is 38%. So if you think about the theory of asset-backed credit or the theory of digital credit, what you do is you take the capital gain you expect in the capital asset, and then you pay a portion of it to the credit investor. If you expect 30% in Bitcoin, you could pay 11% to the credit investor. The excess yield, in this case, the 19% yield spread between 30 and 11, that goes to the equity. And so the common equity investor gets the actual carry or the yield boost. The credit investor gets that first 11% strip of return with risk management principal protection. You could do what we've done in theory with gold, with real estate, or with the S&P index, but you wouldn't be able to pay as high a dividend because those asset classes don't perform as well. So here's another way to look at it. Bitcoin is something for people that want to hold for 10 years. It's a roller coaster. It's got 30 ARR. It's got 30 or 40 volatility. You're going to have years where you're up, years when you're down. You're going to have no cash flow for a decade. Digital credit simply strips the first 11%. You return it to the credit investor, and you get a very comfortable ride.
Bitcoin averages 38% a year. You strip out 11% and return it to a credit investor. The equity investor keeps the rest. The problem is the assumption buried inside that math. That 38% average includes years where Bitcoin dropped 70% and 80%. One bad year doesn't just compress returns. It forces Saylor's team to actively manage around a falling asset while still paying dividends to people who specifically bought in because they didn't want volatility. They've managed it so far. Stretch held par while Bitcoin fell 38% from its October peak, and that took some real work. But this structure has only been tested for less than a year, in conditions that were mostly favorable.
Now, how can we tell? The instrument grew to be the largest preferred stock in the world within 8 months. It's now $8.5 billion. I'm showing you the 10 largest preferred stocks. If you read the chart, what you'll see is that Stretch is a simple thing to remember, STRC. The other stocks are C/PN or POW.PR.E. If you went and searched for these, you wouldn't find half of them. Like, you can't even Google them hardly. How do you buy them and sell them if you can't find them? They're actually institutional products. They were never meant to be bought. Some of them, the ones that say OTC, it's illegal for you to buy them, right? They weren't built for the public investor. They were built for an institutional world that traded credit in the 20th century. And so what's the result? Nobody trades them. STRC isn't just the biggest preferred, it's actually the most liquid preferred in the world in 8 months. Let me say that again, in the world, it's the most liquid one. It's not even 12 months old. Look who it's competing against. Wells Fargo, Bank of America, Fannie Mae, Citi, JP Morgan. It's 25x more than the next best one, and it's not a year old. It's like Superman as a toddler beating the crap out of everybody. And it's because it's Bitcoin powered, right? Now, if you delve a little bit deeper, you'll see that it trades 4.5% of its AUM every day. So it's not just that it's more liquid and it's bigger. It's actually faster, higher powered money. And it's higher powered by an order of magnitude. And so you can see the superior engineering design. Now, what else is highly liquid? Bitcoin. The reason digital credit is highly liquid is because digital capital is highly liquid and the digital equity is highly liquid. And it's not an accident. They're all correlated to each other. If you want to build the one, you have to build, if you want a high energy credit, you have to build it on a high energy capital asset. What else do you want from credit? You want it to be stable. And so you can see it in the middle of the crypto or the bear market here in the crypto winter. Bitcoin peaked in October 6th. It was 125,000 a coin. It's 38% down. STRC is 0%. It's exactly held par. And so what you can see is that the credit instrument is something you can manage to hold principal value. And you need an issuer to do that. That's where the company comes in. The capital instrument has no issuer, no counterparty, no one's managing it. If you're a long-term investor, I would tell you every day, buy Bitcoin, don't buy the credit. But the truth of the matter is, most people aren't long-term investors able to take that volatility. They simply want to put their money in a bank account, collect 10 or 11% and not worry about it, let somebody else worry about it. And STRC is built for them. In February, we got punched in the face. It was a really difficult month, massive Bitcoin drawdown, and it fell to 80 million in demand. In March, it jumped to $1.5 billion. It became an $18 billion a year product. Imagine going 0 to $18 billion a year in the first year. And then in April, it went to $3.5 billion. Multiply $3.5 billion by 12. All of a sudden, 0 to $38 billion a year in a run rate. It's not a year old. So clearly, we're in hyper growth right now. May will be interesting. June will be interesting. Well, private credit yields 8.5%. You could characterize the entire credit market as return-free risk. You're getting 80 basis points of yield over the risk-free rate if you buy investment bonds or corporate bonds. You're getting 200 basis points for junk bonds. You're getting 300 or 400 basis points for private credit that's illiquid. It's all taxable. And we come up with something which pays 11.5% that's tax deferred, that's liquid, that's transparent. If you're a taxpayer in Miami Beach, that's the equivalent to a bank account that pays you 18%. Now what you see is we've created the short end of the yield curve, like the 1-month Bitcoin bond, the risk-free rate in the crypto ecosystem. So what is the free market rate of capital, or the free market cost of capital? It's 11.5% right now. And you can see what the risk-free rate is in every other currency. 3, 2, 1. Zero. And now if you're an investor, you can start to imagine a world where I borrow euros at 2% and I buy STRC at 11% and I keep the difference. Or borrow yen at 70 basis points and invest at 11% and keep the difference. Right? There's a massive arbitrage here. What if you live in New York City? Stretch is like a bank that pays you 24% interest in New York City. Right? What if you live in San Francisco? 23.1% tax equivalent yield. Right? Your money market pays you 3.6%. The bank deposits pay you almost nothing. Why wouldn't you buy it? Volatility. It's too volatile. You can see we've actually taken the volatility from 13 down to 2.3 through the end of April. Our goal is to get it into the ones. We've had it into the one range a few weeks ago. The only instruments in the entire credit industry that have a one volatility are money markets.
Stretch went from $0 to $8.5 billion in 8 months. It's now the most liquid preferred stock on earth, 25 times more liquid than the next closest one, backed by Wells Fargo. It's trading 4.5% of its entire asset base every single day. April demand was running at $3.5 billion a month. Annualize that, and you've got a $38 billion a year product that didn't exist 12 months ago. Nothing in the history of credit markets has grown like that, not even close. And the tax story actually holds up. A return of capital dividend is genuinely deferred in a way most credit instruments aren't. Saylor's 21-year comparison, $100 growing to $965 in digital credit versus $158 in T-bills, is not inflated. That's what higher yield plus deferred tax compounding actually does over time. So why does any of this feel somewhat risky? Because every single one of these numbers depends on Bitcoin going up over the long run, in a specific sustained way that keeps the collateral ratio intact, keeps the dividends funded, and keeps the instrument trading at par. The moment Bitcoin enters a deep, prolonged drawdown, the pressure on this structure becomes something that hasn't been stress tested in public, in real time, with $8.5 billion of people's money inside it. Saylor knows this. He said it himself. If you're a long-term investor who can handle the volatility, buy Bitcoin directly. Don't buy the credit. He's not hiding what this product is built for. He says it's built for people who want yield now and can't stomach the ride. That's it for today. Drop your thoughts in the comments. See you in the next one.